And then, of course, like yesterday, there was a bit of a recovery, and then that recovery was sold into, and we ended flat. So let's see what happens today. The Sensex is down 300. You've got the Nifty Bank, which is down about 180 points, 0.4 lower. IT index is up on your screen. And yeah, I mean, 660 higher and about 700 lower. Yesterday, advanced decline was quite positive. Today, it's mixed. It's almost evenly matched, at least at the word go. The heat map will come up on your screen as well. We'll look at what the Nifty 50 screen is looking like. Should be more down than up, looking at where the indices have opened. But let's get to stocks. Surabhi.
You know, it's already looking good, Prashant, and I'll tell you why I'm saying that, because look at the mid-cap index. It had a cut of about 0.6% at open. It's already recovered. It's flashing a little bit of green, and the bulls will really want to see this continue. But anyway, on the large caps, let's see where the pressure is coming in from. ITC is down about 1.5%, and okay, now the auto stocks are falling, taking note of the SIAM commentary. So Maruti 1% lower, M&M is lower by about 1%, iSure is down by about 0.5%, Hero is down by about 0.5%. So yes, auto is a bit weak. Then there is HDFC Bank. It's exerting a fair amount of downside pressure, 1% lower. Other heavyweights lower include L&T. There's TCS, which is lower by about 0.5% as well. You've got names like Titan and Tata Consumer, Nestle on the consumer side. So a couple of these consumer stocks are lower. Lever itself is down about 0.5%. So consumers also weak. Now let's talk about what's actually moving higher. There's some buying on a couple of financial names. Shriram Finance is the Nifty winner at this point in time, 1% up there. SBI Life and HDFC Life. The life insurers are having a pretty decent morning so far, at least. And Infosys is fighting hard to stay on the top side of the screen, but let's see if it can continue or not, because otherwise it's looking a little weak. The Nifty fall, by the way, is about 80 points at the start. Some financials up. Reliance is a big one. It's sitting on the fence. Depending on which way it goes, obviously the Nifty will follow, but 80 points lower for the time being. Nigel.
Well, let's pull up a few stocks. Yesterday, JBM Auto, they won a big order towards the end of trade. That stock is seeing some follow-through buying today. It's up closer around 3%. Acme Solar, Nimesh had told us in D-Street Chatter yesterday that, in fact, that was seeing some bit of interest from larger hands. In today's trading session as well, that stock is up closer on 2.5%. So JBM Auto, Acme Solar, both of them are higher in trade. Borosil Renewables, it's been moving from circuit to circuit. Last few quarters have been weak. The management has promised better times ahead. They're talking about margins back at around 30% because of the duties that they've got in terms of protection for the domestic industry. It's up another 5%, moving circuit to circuit. Vare, they won an order, I think a small one, 280 or 300 megawatt of order for their modules. So that one as well had opened up initially in the green. I think, for these companies, the big test will come once that lock-in opens up. For the time being, the stock is up 2%, building on post yesterday's 2% returns. Zen Technologies, at least for starters, that's building on to gains. That is one of the top volume gainers today. So I think we should pull that up. That's up closer around 5%, following up yesterday's big surge that we saw of around 10%. Remember, the stock is still 45% off its peak, but for starters, it's higher. Cyient, they have a new top boss, who's been appointed, and the street likes that. So Cyient is a stock that's up closer around, I think, 2.5% or thereabouts. Mr. Banerjee has come on board. The stock had corrected from around, I think, 1,750 all the way to around 1,400 rupees. So that as well is popping back up. NetWeb, the stock that's down 40% in this year, well, that stock, in fact, has opened up in the green and is trying to pull back some of those losses. On the losing end, Bikaji is a stock that's giving back some of that rally that we saw in the last couple of trading sessions. So Bikaji, I think, is down now close to around 3% or thereabouts. So it's a negative start. Advanced decline ratio, the 22,800 mark here again.
Well, so we're down about, 70 points now, and we're at 22,860. Just a couple of more names. Rate gain is something we highlighted day before yesterday, and this morning Deepan had it on his watch list. So from the lows of about 500, actually maybe it fell, yeah, it did fall under 500. This was on Tuesday. The low was about 475. It's back to about 516, 515, 516. Decent sized volumes as well for this point. There is nothing extraordinary, but decent sized volumes. Delta Corp is, I think, almost back in 3 digits. So almost, not quite. Delta Corp will come up on your screen. Again, I mean, here the low earlier this week was about 89. So that's bounced. There is a car trade, which is coming up with small gains, but nothing big. There is Tata Investment Corp, which was up 14% yesterday. And it's up another 7%. Tata Investment Corp is just a sort of, stock holding company. It has a high quality, mostly large cap, some mid cap names as well, which it holds. And that's essentially the business. So it's like a fund. You could buy the stock and it kind of reflects the value of the underlying portfolio. And that's about 8% in the green. That's 25% in 2 days. Vivek was talking about NHPC, that's about 1.33% higher. And I think the others we mentioned, Zentech, Nigel mentioned, NetWeb we mentioned, NetWeb back about 1,500 rupees. And maybe throw in a Tata Tech as well, which is up about 2.6, 2.7%. At this point in time.
361, wealth management. Just thought I'll put that up. I think
Yeah.
the market's trying to see if it wants to go back to some of these capital market plays. Yesterday, BSE had a great day. Let's just pull up BSE as well. And this morning, it's 361, which is showing a gain of about 3%.
Absolutely. Let's just look at maybe IIFL as well, since we're looking at this one. IIFL is the other one, which is, but that's a NBFC, but 313, completely bombed out, right? But the top volume-led loser, by the way, is, guess what? Mahindra & Mahindra. M&M is down 2.5%. So, and it's got humongous volumes. It's number one volumes on the NSE. Mazgaon, and I think I see one or two other defense names, they were all up 8-10%. Mazgaon at least is down 2.5%. And the other one, which I've not seen any news flow with regards to, is Credit Access. Credit Access was down 7%, 8% by close yesterday. It's down another 3%. So 867 on Credit Access. It's been in this 850 to 1100 kind of zone for a while now. And once again, it's back to the lower end of this range. But let's welcome in Tahir Badshah, who's with us, Chief Investment Officer at Invesco Mutual Fund. Tahir, good morning. Great to have you with us here on the program. Thank you very much for your time. Do you believe, Tahir, that this is base building, some kind of bottom formation? The process is on. What's your sense?
I would like to think so. I think the market is trying to get a hold of itself around this level after having seen a very vicious correction over the last month or so. I would think that we had certain issues as far as our domestic economy is concerned, particularly with respect to growth, as we all know. And I think some of the measures which have been undertaken in the recent past, both by the regulator, the central bank, as well as the government, I think should probably, help us to stage a slow recovery. It will be a slow grind as we see it probably in the first half of calendar year 25. So I think by and large, from the domestic standpoint, we are kind of fine. Of course, the global environment still to our mind remains tough. And we'll have to see how this whole thing pans out with regard to the entire world trade situation. I think that's a lot more belligerent than I probably initially estimated myself. And I think we will probably have to face some consequences of that as well. So I think it's been a lot more belligerent compared to not just for India, but even for the rest of the world. And I think that's something which probably will be a headwind for the market for some time.
By the way, I just want to pull up Mahindra & Mahindra once again. Prashant was pointing this out. The stock is very, very precariously poised. The only reason I'm saying that, of course, our chartists will know better, but it's now at a 6-month bottom. I mean, this is, if you talk about the trading band that M&M has been in the last 6 months, this is exactly where the stock is, 2,700. So these would be crucial levels. That chart will tell you the story. Now, whether it breaks this 6-month range or not, we will see. But there's a lot of additional pressure coming in. Let's pull up once again maybe a 7-day chart. We've been showing you that what the stock has done. 7 days has been absolutely pummeled, 14-15% gone. And this ties in, 13% down in 7 days. This ties in, Tahir, hi morning. It ties in with exactly what you're saying, right? This tariff issue or whatever's happening on negotiations with the US, they are beginning to act up. I mean, a part of perhaps why M&M is falling, maybe you could say attributed to profit booking. Stocks had a dream run. But there is genuine fear, right? There's genuine fear about what happens if US automakers start, rolling in on Indian roads, if those tariffs are lowered. This morning, anyway, we've got a very bleak outlook from SIAM, talking about just 1 to 2% growth in PVs, X of SUVs. SUVs are doing well. How would you look at not just M&M, but in general, the large cap auto space, which has anyway failed to fire in the last many months, barring, 1 or 2 names?
So I agree with you, Sylvie. Like as I said, we are going to probably see some of our Indian industries being at the receiving end of things as a result of this whole reciprocal tariff issue. And probably autos could be one of them in some way or the other. And that is something which has been very prominently highlighted by the US president as well. So I think to that extent, that is something which there will be a few other sectors as well, in my view, I think, which will probably have to see as to how either we get impacted due to lowering of import duties in the reciprocal process, or probably we see higher import duties ourselves on certain products, and which wherein we will probably have to be, we'll have to contend with as to whether we can pass through that cost or not into the US system. So I think those are things which will probably matter, and that is something which will not immediately resolve. We anticipated some part of it, like as I said, it is a little more vicious. And we'll have to probably be a little more careful about some of these sectors which are potentially at risk.
So what is your current stance, Tahir, on both autos, large cap OEMs, as well as ancillaries? Because there's too much change going on. When Bharat Forge this morning announced an order into the US, which is great. But again, we need to see what happens with tariffs. So what are you doing? Are you buying this weakness and this weak phase in autos? And what about ancillaries?
We've tried to, like as we've done in most other sectors, even within autos, I think we've tried to kind of, position ourselves in pockets which are a little more resilient compared to others. So in every sector, for that matter, we'll have to do that for the coming some time, where we will have to differentiate between performers or executioners versus those who are probably not able to execute as well. And I think there'll be some segments which will be at higher risk to growth compared to others. But I think at this point in time, for sectors like autos, etc., it is very important that we get a boost as far as domestic growth is concerned. We might probably need that for some more time, till the time this global issue settles with regard to tariffs. So I think it is important for the government at this point in time to just go all out in terms of supporting growth as far as the domestic economy is concerned.
Hi, Tahir. Good morning. Good to see you. And Tahir, two themes that did well and the street was very excited about was EMS as well as quick commerce. I think you as well were quite positive on both those two. Both of them have cooled off a little bit. Now, does it make it even more attractive, or would you want to wait by?
We've, at least as far as quick commerce is concerned, I would say that we have nibbled into it, especially in this correction. I think it'll take, again, year to the food delivery part of the business, and most of the companies which are around is well understood and is well discounted, and to that extent, that remains a reasonably good support as well for the entire enterprise as such. For quick commerce, of course, we will probably we will go through a little bit more grind compared to what we had thought earlier. And we'll have to probably allow for competition to kind of settle down. That will probably take a little longer, in my view, compared to what it has probably been for, let's say, the food delivery business, for that matter. But I think currently, market has been in that mood where, by and large, it is almost starting to attribute zero value, or very little value, for that matter, to the quick commerce business. And I think it's not that extreme either. So I think that is probably what is giving us that confidence to nibble in.
A point taken. What about Tahir, pharma as a space? Again, in the context of what we've heard, all right, the 25% tariffs on pharma imports into the US, which Trump is talking about. One argument which is pretty straightforward to make is that who wants higher cost of drugs, right? Medicines. But on the other hand, I mean, one doesn't know. They're talking about reciprocal tariffs. Have you looked at, have you and your team looked at what this does to Indian pharma?
Yeah, so, I think this is again something which we have to still, we'll see how it evolves, because we don't really know exactly what these specific tariffs could probably involve. There are two sets of considerations here. One is to neutralize the deficit at an aggregate level, and then it is also about reciprocal tariffs. And I don't think it is one versus the other. Both will probably happen simultaneously for every sector, and so goes for pharma as well. So again, coming back to the same thing, that we'll have to probably once again, differentiate. There are some companies which are at relatively higher risk compared to the others. I think some of my sense would be, and this is something which I'm not fully confident about, but I would still like to surmise that some of the more companies which are at least operating in some of the more critical areas, CDMO, etc., probably should be a little more better off compared to what it would be for the others, especially those who are in the generics business. So I think that is where, once again, we will have to probably differentiate and wait for the final print to come through. But this is once again a sector which could be in the throes of this dilemma.
Here on the market as a whole, what's the sense? And particularly, this question is pertaining to the mid-cap and small-cap space. And you've been a master of the broader market for so many years, right? And I think that's the issue. People don't know whether to start venturing in now, go and buy. In fact, there are some AMCs which have recently launched small-cap funds, mid-cap funds as well. So is this the time to go in, or do you still wait? You've seen these cycles before. When do you know that the worst of the broader market capitulation is over? What are those signs?
No, so we always have different contexts and different conditions which are surrounding every correction and every rally, which we have seen in mid caps and small caps. And so we had our own domestic problems at one point in time in 2018 when we last saw the very punchy crash in mid cap and small caps. And this time around, we have a completely different set of conditions, probably a little more global-led, somewhat local-led as well. But I would like to think at an aggregate level, generally, these are drawdowns which do indicate a start. You never know when to exactly time the bottom. You never get that unless you're very lucky. But I think there's a good time to start. I think the risk rewards are now getting a little more tolerable compared to what probably they were a few months ago. It will be a market which will probably a little more differentiating, nuanced. We'll have to probably build our portfolios carefully going forward in order to ensure that we at least manage to get better than system rate of growth. And if we can probably do that, then I think there's a fair chance of being able to outperform over the next couple of years.
All right, Tahir, on that optimistic note, we will wrap up this conversation. Thank you very much for joining in and giving us a perspective on the market. And we already see our next guest ready for us. So let's put the spotlight now on Mahanagar Gas. Of course, there's plenty to discuss with the management, but the latest headline was BMC directing all the eateries, bakeries and hotels, roadside vendors here in Mumbai to switch to clean energy as well as eco-friendly fuels. Let's discuss this and a lot more with the management of Mahanagar Gas. We have with us Mr. Anshu Shingle, MD at MGL, joining in to take a couple of questions. Mr. Shingle, thanks very much. Good morning to you and thank you for joining in. We really want to talk about what this BMC measure means and how meaningful it might be for volumes. But before I get to that, just to sort of understand the bigger issue, which obviously was plaguing not just Mahanagar Gas, but other city gas distribution players as well, which is how much of this APM gas will companies actually get? I mean, just going over history, the market sold off big time thinking you're not going to get as much APM gas, but then it was hiked up. I think now it's 50%. So let's just talk about MGL's gas mix. What is the pricing looking like for not just APM gas, which is regulated, but other sources? And therefore, what can we expect in terms of cost of your feedstock and the final output and the margins? Where are we now on your gas security?
Yeah, I think the gas deallocation happened somewhere in October first time, and November again, the second cut was happened. And from 68% CNG, it came down to around 38% the CNG allocation. Actually, we have three segments. So for the domestic PNG, we are getting 100% APM or the domestic gas allocation. For industrial and commercial segment, we are anyway sourcing LNG, which is the imported gas, or the HPHT gas to some extent. And for the CNG segment, we were getting around 68% and it came down to 38%. But in January, it was restored back to 51%. Now, this cost has impacted the procurement cost, and maybe we had around impact of 6 rupees per SCM. So partly we have increased the prices and partly the deallocation has been restored back to the normalcy. So we think now, as of now, our margins will be in the similar range what we have earlier guided, from say 9 to 11 rupees EBITDA per SCM. So I believe the LNG market going forward is going to be more surplus, and therefore we can source more term contracts and do our portfolio management in a way that we pass on some of the cost and we absorb some of the cost to make the impact on the market minimal.
Mr. Shingle, since we are covering the big picture points first, what you're saying is that with this blend, with this mix, you should be able to do margins of about 9 to 11%, right, per SCM. That's what your guidance is.
It's not the percent, it is rupees per EBITDA per SCM.
Rupees per SCM, yes, 9 to 11 rupees per SCM. Now, right. We are also living in very uncertain times where the US is having an impact on almost everything that we're doing, right? Including, obviously, energy security. And there seems to be a huge push to source more oil and gas from the US. So I don't know if India has to source more US, LNG. Does that impact Mahanagar Gas in any way? Are you already thinking about those scenarios and what that does to your blended cost? Because the freight will obviously be more.
No, anyway, we are importing a lot of gas which is related to Henry Hub, which is the US gas. So we don't directly import this LNG. It is through the aggregators like GAIL, BPCL, IOCL, and other players. So we do the tendering, and typically gas comes through the regas terminals, and from pipelines it has come to the company. So
no, absolutely,
as of
sir.
now,
No, sir, we're aware of that, sir. I was just saying that if these big importers, GAIL, etc., Petronet, I mean, if they have to source more US LNG, will their cost be higher and therefore that higher cost gets passed on to you? I mean, I'm just asking about an outlier scenario. Suddenly, if we have to import far more US LNG.
No, I mean, that is a good scenario for India because Henry Hub is the US index on which the gas is imported to India. And that is a more stable index. So earlier also we have seen that the price volatility in the spot market and the Brent was much higher as compared to the Henry Hub index. Henry Hub index moved from say $3 per MMBTU to $7 per MMBTU in the pre-COVID and COVID times. Whereas the spot gas moved from say $2-3 to $70 per MMBTU. Even the crude moves from $20-30 per barrel to $100 per barrel. So we feel that HH index is very mature because maximum quantity of almost 40% of gas consumption in the whole world is being taken place in US only. And they have started exporting also. Now, so therefore the cost is very stable as far as we can see the situation.
And guess what, Surabhi? What's the one commodity which investors expect? I was reading a survey to most affected by ceasefire in Russia, Ukraine, gas. Lower gas prices.
Because the Russians can start, pumping through.
So
pretty
that
much.
is, and add to that, of course, the fact that I think if you go through most estimates, we will likely have a gas glut in 2025 and beyond for the next few years. So we're looking at lower cost of the stuff, raw material. So thank you for joining us, Prashant here. Let's just talk about something very local here in Mumbai. So the High Court had directed BMC to ensure the shift to gas for commercial establishments, roadside vendors, eateries, restaurants, etc. in a timely manner. Now, BMC has issued some directions to this regard. Could you tell us what could be, I mean, is there an internal estimate? What would be the bump in volume if this were to happen, sir?
See, the commercial establishments are basically big hotels where 100% of the big hotels are being supplied the piped natural gas by MGL. Then there are small restaurants and the eateries are there, and then the bakeries are there. Now, around 4,500 commercial establishments are also getting piped natural gas. The other fuels option for the restaurants is LPG. And for small eateries, it is even wood, and for the bakeries, suppose it is wood and coal. And also LPG, PNG, and electricity ovens are also used for bakeries. Now, there's a mix of all these fuels. As you rightly mentioned, the Mumbai High Court has mentioned that some of these eateries need to move out to the cleaner fuel. So we will be evaluating that how much of they can be accessed. And there is a question of affordability and the licensing and the clearance from the fire department. So all these things plus our access to all these places, because some of these bakeries are situated in a place where PNG cannot reach, because for PNG we need proper safety and other measures which needs to be assured before we supply gas. So that needs fire clearances also. So volume-wise, as of now, around 0.2 MMSCMD is going to commercial establishments, and around 0.5 MMSCMD is going to the industrial establishment. So volume-wise, it is very low, but it will have more impact on the pollution level because wood and coal anyway is very polluting as compared to PNG or LPG or even electricity.
Mr. Singhal, so just to give us a CNG estimate, right? For the 9-month period this year, volume growth has been about 11%. Could you guide us to what could be the full year number? And then for more importantly, 26, what are you expecting?
Yeah, if you see year-on-year growth, last year was whole year 5.5%. In this 9 months, we have clocked a growth of around 12%, and CNG is around 10 to 11%. Now, going forward, the industrial and commercial is growing around 14% or so. So we expect next financial year also to be in double digit, at least 10-11% numbers are expected, because Domestic PNG, we were the company, we did the highest numbers in the domestic PNG segment, around 3.3 lakh numbers. And in CNG also, we are adding more infrastructure. Around 50 stations will be added this year and another 50 in the next year. So we think more than 10%, 11% or 12% we can be the new number for growth numbers we expect from both CNG, INC and PNG put together.
So 10 to 11% volume growth, right? And 9 to 11 rupees margins per SEM.
That's right. That's right.
Okay. So very quickly, just 30 seconds left. Just leave us with an outlook on a lot of your EV initiatives. I mean, you've put a fair amount of money to work. You've acquired some entities as well. So when does the revenue and profit start flowing in from those initiatives?
So there is a small investment. We have taken around 31% equity in a three-wheeler electric vehicle manufacturing company in Bangalore. So that company is already starting, revenues are being generated in that company, and it's a startup. So it will scale up after a few years or so. It will take some time. Besides that, we have taken some joint venture position in a battery manufacturing company, cell manufacturing for a battery company. And that we expect will be ready by 1.5 year time. We already have got the land and the civil work has already started. So it will take around 1.5 year time to start the production from the battery manufacturing cells.
Okay. All right. Thank you very much, Mr. Shinghal. This was, very helpful. Thanks for clarifying all of those points, including, of course, the outlook ahead for MGL and what happens in case, even if India has to import far more US LNG, it's good news. It's not a problem. So that's the word coming in from Mahanagar Gas. And the stock's doing rather well this morning. Nigel.
Well, that's right. Let's slip into a short break, though. On the other side, we'll have the management of Maharashtra Seamless, who's waiting for us. Mr. Kaushal Bingani, the Deputy General Manager at the company, is waiting for us. Stay with us. Welcome back. Well, Maharashtra Seamless, that's a stock on our radar. It's corrected close to 40% from the 52-week high. The company reported improved performance in the past quarter. But how are things shaping up? The order book is something that the street is looking forward to. And the promoter entity as well has been buying some shares in the open market. We have with us Mr. Kaushal Bingani, who joins us on the show. Hi, Kaushal. Thanks a lot for joining in. Well, let's get a couple of details first out of the way. We have your total order book, which was roughly around 1,700 crores as of the past month. And normally quarter four is when you see some increased ordering activity coming in, particularly from the oil and gas space. What is the updated number? And is there any ordering trends you're observing from ONGC and Oil India, which is better margin business?
Good morning, Nigel. Thank you for inviting us. On the order book, it is currently at 1,674 crores right now. There has been no change in the order book because we've been able to replenish whatever we've dispatched with fresh orders. You're right, more orders are expected in the current quarter. And I think towards the end of February or towards the first week of March, we should get some more new orders in, which would be beneficial for the company. And these would be from the oil and gas sector.
Okay, all right. The reason I ask you is because ONGC as well as Oil India as a percentage of your total order book has come down to around 34%, which is much lower than the 50-60% we have seen in the past. Do you want to hint at the total quantum of the orders that you could win towards the end of February as well as beginning of March?
The dip is more on account of a timing mismatch because the lumpiness in order inflow is always there. So in one go, we can get a large order and then there will not be any order for the next few months. That's the way the ordering position normally remains. And I think it is more on account of that rather than the average that we get for the entire year from our oil and gas customers.
Okay, all right. Let's get a couple of details and out of the way, and we'll wait by to hear from you in case there is an order win. What about the guidance on the EBITDA per ton front? I'm looking at the last quarter, the seamless pipes. Well, out there you had a good improvement. It was at around 20,000 rupees, while the ERB was around 2,700 rupees, which is a smaller part of your business and continues to struggle. What's the guidance on both these two parameters? And also, what is the volume growth we should work with for both these two segments?
I'll take the volume growth first. In last financial year, we dispatched around 400,000 tons of seamless pipes. This year, in 9 months, we've dispatched 324,000 tons of seamless pipes. And we expect that we will dispatch around 435,000 tons of seamless pipes in the entire financial year, which gives a volume growth of around 7 to 8% on a financial year-on-year basis. Going forward in next financial year, we expect to dispatch around 4.5 lakh tons. The reason why I am giving that figure is because one unit is being revamped. One bottleneck was there, which we are working to resolve. And by December 25, it would be done. So because of the activation of that capacity, we expect an additional 15,000 tons in the last quarter of next financial year, bringing the guidance from 435,000 to 450,000 for financial year 26. The guidance for the next financial year would be more than that because once that finishing line installation and commissioning is completed in December 2025, then the entire benefit of the next financial year would be available and we would be able to dispatch, I think, around 500,000 tons in FY27. That is the growth guidance on the tonnage front. On margins, at the start of this financial year, I had given a guidance of 15,000 rupees per ton for seamless pipes. Over the 9-month period that has concluded since then, we've achieved 16,500 rupees per ton. And going forward into the end of the year, I think we'll do more than 16,500 rupees per ton on an annual basis.
Okay, all right. So just to get these numbers correct, seamless at the end of this year, 435. At the end of FY26, 450,000. And FY27, around 5 lakh tons, correct?
That is correct.
And EBITDA per ton in seamless is 16,500 tons. 16,500 rupees.
Yes, 16,500 rupees for the entire financial year.
Okay, all right. And ERW, you want to quickly give us what you'll do? As of 9 months, you've done around 77,000 tons. How much will you do for the year?
I think ERW will do around 90,000 tons for the entire financial year.
Okay.
And margins are varying between 1,000 to 7,000 rupees per ton, depending on the price of the product which is being dispatched, because prices for oil sector products are different from that in the water sector. So it's more of a
Okay.
function of the product mix rather than anything else.
Okay, all right. Kaushal, I wanted to ask you about this cash in your books. Very good to see cash in your books, which is 30% of the market cap. But what are you all doing with it? Don't you think it would be more prudent to return that money back to the shareholder, give a dividend, do a buyback? I'm looking at the breakup. Most of it is going in mutual funds. And mutual funds, now they're subject to risk, right? I mean, why don't you all just return some of this cash back to the shareholders? What is the thought process?
I like your enthusiasm, Nigel, and we are working on it. So we have quadrupled the dividend which we paid in the past 3 financial
But
years.
it's still
And we've
very,
also
very small. But it's still very, very small. It's very, very small. And it's not just my enthusiasm. If I look at your total institutional holding, which was much higher, that's come down. And that's predominantly because of this, sitting on cash and not returning it back to the shareholders. So by when can we hear some kind of a resolution with regard to this cash that you're sitting? Otherwise, it's just a valuation argument, which the shareholders are not getting.
That is correct. And to that effect, the promoter purchasing has also taken place, but that's a separate issue. As of now, we've announced a capital expenditure plan of 850 crores, which is commenced, and bit by bit, we are addressing each of those capital expenditure items. We don't have a dividend policy right now, but we'll just have to wait for the next board meeting in which dividend for the entire financial year would be announced, and we'll take feedback that you've given right now into account.
Okay, all right. And since you spoke about the promoter, he's buying from the open market, so that gives some kind of support. In the last few days, he's bought close to 5.5 lakh shares. And I recall, it's moved up from that 65, 67%. It's now at around 68.5%. Any targeted holding that the promoter wants to have in the company?
So promoter group have expressed their desire to raise up their promoter holding from current levels of 68% to 75%. And to that effect, in the past 6 to 7 years, they've improved the promoter holding, which was earlier at 60% to 68.07% as on 31st December. And in current quarter, they've purchased, I believe, around 7,50,000 shares, which is around 0.56 or 0.57% of the total equity capital of the company. And we have received communication from promoters that they want to increase their stake going forward.
Okay, we'll leave it there. We look forward to hearing from you soon again. Thank you very much for joining us. Let's talk about PTC Industries now. That's the next company on our radar. Third quarter was a stable performance. They've successfully commissioned the arc remelting furnace. It's one of the largest here. It's also the first from a private sector company, I'm told. We'll talk about all of this with Sachin Agarwal, Chairman and Managing Director at PTC Industries. Sachin, good morning. Good to have you with us here. Thank you for your time and thank you for waiting. Prashant this side. So commissioning of the furnace was in line with expectations which were out there. And many believe, and I saw this note from ICICI Securities that this will be earnings accretive from FY26 onwards. Could you give us a brief overview of this facility and what kind of revenues are you expecting?
Good morning, Prashant. So thanks for inviting here. This commissioning is amongst the first equipment that is getting commissioned for titanium alloy manufacturing in our new mega facility, which is being built over a 50-acre land. It will be one of the world's largest, if not the world's largest, titanium alloy and products manufacturing capability, fully integrated into a single site. Right from producing from titanium alloys to making titanium products from bars, rods, sheets, plates, all type of raw material products, castings, forgings, the entire value chain, manufacturing supply chain that is required. The first commissioning of the VR is very, very historical. As you said, it's the first time any private company is producing this at this scale in India. We already have order backlog already in place for this. Order bookings have started. There is a big gap in the world in terms of titanium supply chain, especially given all this Ukraine and Russia thing that's happening worldwide, which is created for the global OEMs for aerospace a big challenge for sourcing titanium and titanium products. So this is filling a very big gap in the industry, in not just in India, but also worldwide. There is also a big value addition that we do, right? From getting in material from almost 800 rupees a kg to selling products all the way up to 1,50,000 rupees a kg. So almost between 10x to almost up to 100 to 150x increase in value addition. So, and everything in between. So, it is a very, very mega project in that sense.
No, that's very, very interesting to hear, and I would love to chat more about what all this goes into, etc. But we're a little short on time this morning, Sachin. Could you tell us what is the at full capacity utilization, what's the revenues this will generate for you? And margins as well. Yeah.
Okay, sure. So if you read, coming to the margins first, if you see our previous quarter and the previous financial year, we are at around 30 to 35% EBITDA margin currently. Without this new facility coming in, the revenue for this year, we probably will be around 40% growth in the previous year. The next year, we will be around 100% growth. The potential revenue from this is at least 10 to 20 times our current revenue when it reaches close to full capacity across the entire thing, from titanium materials and superalloy materials to superalloy castings, titanium castings, forgings, and all products that are getting made there. So the total revenue potential for this site or for this company is between 10 to 20x of what it stands in next 5 to 7 years. The EBITDA margins are going to grow even further. We are at around 30-35%. I think it will remain at least at that, or potentially grow to somewhere closer to a 40% EBITDA margin.
Mm-hmm. So revenues were 250 crores, right? Last year.
Around 270 crores, yeah.
270. You're saying that will grow 40% this year?
Yeah.
And then
30 to 40%, yeah.
30 to 40% in 25, and then it'll grow 100%. In 26, 26.
27.
Yeah, and this from this particular commissioning, you're saying your current revenues can grow 10x, 15x.
10 to 20x, yeah. From this alone, yeah.
Wow, and this is over what period of time?
Between 5 to 7 years. This also includes our acquisition abroad in UK. We have acquired another. So we're completing as I said, I think I probably need a longer conversation on this, but the entire supply chain is being covered. We have acquired a company in UK called Track Solutions, which machine airfoils for aero engines. This is the technology which is not being provided to the country for a very long time, especially in even the current deal with GE. So it machines airfoils, coating, drilling, all the work that is not being done in India. We have acquired that company. So it gives us a very long run on the entire value chain. And that is the target of the company, to complete all the technological and capability gaps in the country in the metal-related sphere. So yes, between 5 to 7 years, quite a large increase in revenue.
So it could be about, taking last year's number, it could be this alone could be about revenues at full potential could be 2,700 crores more, 3,000 crores from this commissioning.
Yes,
7 years out.
More.
Okay.
Mr. Agrawal, so that's a 7-year projection from this one facility that you've, this one process that you're just starting. But I want a slight more near-term view. You said next year growth is going to be 40%. Say over the next 3 years, what is the CAGR? Because you're in very exciting segments, and also throw in some more light. I believe that you've done an MOU with the UP government in the new UP Defence Corridor, and you could be involved in subsystems or parts. So some of the Su-30 components as well. There's an MOU with the Odisha government for aerospace-grade titanium sponge. So these are all very, very exciting sectors to be in. Just tell us how much are you expecting from the Odisha MOU and which year, how much from the UP MOU and which year? Tying into my overall question, CAGR growth for the company, top line and earnings, profits for a 3-year period. Do you have that projection right now?
So coming to your MOU part, so with the UP government, the MOU was almost a couple of years back. Now there's the plant that I mentioned about in the mega project that's going on in 50 acres is in the UP Defense Corridor, right in front of the BrahMos facility in Lucknow. So that's already ongoing. So that's where we are having these major investments going on. And I expect all the commissioning and all the execution of the work is going on very well and actually ahead of time. So we'll probably be by end of the next year, all this will be commissioned and in production. So that is where we mentioned about the existing potential for the growth of revenue. The Odisha government, the titanium sponge, we have just signed an MOU. All the financials and everything are getting worked out. All the details of the policy and what incentives we can get from there are being worked out. Just talking about the MOU with UP government, we have got a 25% capital subsidy scheme has also been introduced in the aerospace and defense policy. So there will be a good incentives that will be coming to the company as well through that policy. The CAGR part, what you mentioned, as I mentioned, this year will be around 30 to 40% growth. Next year, about 100%, then probably another 50% to 60% growth after that. So if you're looking at an average, probably a 50% CAGR for the next 3 years. 50 to 60% CAGR for the next 3 years.
50 to 60% CAGR growth next 3 years. Got it. Thank you very much, Mr. Agarwal, for joining in with that conversation and an outlook on what you intend to do as well with the business. Well, we are now at 10 o'clock, so it's time to quickly go back to the market and see how we are faring. The indices, I mean, Nifty is still nursing a cut of about 60 points, but the mid-cap index has held on to its green. So let's quickly go across. Shilpa Raut is joining in for some trading ideas. Shilpa, good morning. What are you doing today? Oh, I think we've lost that line with Shilpa. We'll try and get her back. Just to go back to the screen, the cut on a couple of these auto names, it's really showing. Maruti, for instance, is the weakest stock on the Nifty right now. It's down to 2.5% as we speak. And the other problem for the Nifty is HDFC Bank. HDFC Bank is looking at sustained weakness, 2% down there. It's not alone. Even Kotak is weak, ICICI is weak. Basically, Bank Nifty. Yesterday, Bank Nifty was the big star. It was outperforming the Nifty by a mile. Today, it's the other thing. Bank Nifty is keeping a lid on the Nifty's up move. Let's take a break. On that note, we'll come back with the commodity cues of the day in just a bit. Welcome back. As promised, let's head across to Manisha to get a lowdown on the commodity markets. Manisha, good morning once again. So what are you tracking right now at 10 o'clock?
Well, I'm looking at the copper prices, and last week was a great one. And this year has started on a positive note for many of those metal prices, but it doesn't seem to be heading there now, especially for this week. So when you look at the copper prices, it was a 7-month highs in the previous week. We did see a high of 9680, and now currently the prices are trading at around 9350. And the markets do believe that you could be looking at prices declining from here and when. The bigger concern clearly comes in sense of tariffs there. Also, when you look at the US and London prices, the gap is widened to a 10% right now. US is trading at a premium and London at a discount right now. So you're looking at almost $100 of a premium in the US markets. That is how they're commanding it. The US also, in addition to various other tariffs, has proposed auto tariffs to the neighboring number of around 25%. There are duties on semiconductors as well talked about. There also is conversation that US could be putting tariffs on copper as well. A date on that has not been decided. There's a conversation though going, and I've seen a lot of those kind of reports coming in. The markets also have seen the US and Russia conversations. If those proceed better, then you could be looking at Russian copper coming into the markets as well. That's another concern that the area has, and you have seen copper prices come off because of that as well. China ordering restrictions on many copper smelters due to excess capacity has been yet another reason. And then the reason that you saw 2% of a decline come in for copper prices in the overnight markets came in because of a Citi report, which has downgraded their price forecast for 2025 and 26 as well. Earlier, Citi put out a price saying $9,000 a ton is what they're looking at in sense of average prices for 2025. They've cut it down by $500, saying $8,500 is what they're looking at in the next 6 to 12 months there. Also, Citi says that for the year, you could be looking at a small deficit this time around at around 136,000. So this is much lower than where we were in the previous year. So the deficit also has declined. You could be looking at more supplies coming into the market, and that's weighing onto the space. That's exactly what you can see in sense of this chart as well, where we have seen copper prices decline on a week-on-week basis, down by nearly 4%. But on month-on-month basis, we still are up by 7% for copper, up 15% in this year. And the last 12 months has seen copper prices hold those 18% of gains.
All right, Manisha, thank you very much for that. You know, what we're going to do is take a quick commercial break here because our guests are ready, and it's the Indianomics segment. My colleague Latha will be speaking with top experts. We'll have Ajay Srivastava, Chetanaya, and Samiran Chakrabarti on Indianomics, and of course, everything which is happening with trade and its implications for an economy like India. Stay with us.
Well, welcome to Indianomics. In every speech, the US president has threatened India with reciprocal tariffs. Even if it's a general interview, India finds mention. Now, how much higher can the tariffs go for Indian exports to the US? Which sectors are vulnerable? And what's the impact on India's macros? You know, on inflation, deflation, growth, current account deficit. Those are the other questions. And of course, what's the impact on Asia as a whole? Where do we stand in terms of comparative disadvantages? I have three experts to discuss all these questions. Samiran Chakrabarti, the chief economist, India at Citi. Ajay Srivastava, the founder at Global Trade Research Initiative. He's a former civil servant and therefore knows a thing or two about the Commerce Ministry. And Chetan Ahya, Chief Asia Economist and Emerging Markets Specialist at Morgan Stanley. Chetan, Samiran, Ajay, Mr. Srivastava, thank you very much indeed for joining me. Well, Samiran, first the macro question. You know, how much should, what is our total exports to the US as a percentage of total India's exports and as a percentage of GDP? So what's at stake for the macro?
So our exports to US, the merchandise exports part has gone up quite substantially. So we are now exporting around $80 billion to US. And that's about 18% of India's total export. So from that perspective, it's quite substantial. The growth has also been quite good. And more importantly, what has happened is that our trade surplus with US has widened, almost doubled from around $25 billion to now, by US estimates, almost close to $45 billion. By our estimate, the number is more closer to $38 billion.
Okay, so that's a substantial amount of money. But as a percentage of India's GDP, assuming a lot of this is impacted, how much would the, as a percentage of GDP, the exports be?
So by India's GDP, it's only about 2% of GDP, because India, as we know, is more a domestic-focused economy, not as much an export-oriented economy. So from that perspective, when you put it in a scale of how other countries are susceptible to these risks, India will probably stand at a lower end.
Okay. Chetan, good morning, and thank you very much for joining us. Your report shows that relative to other Asian countries, India is more vulnerable because we tariff the US imports much more than other countries?
Yeah, I think that there are three factors that we are looking at when we are assessing the exposure to tariff risk. Number one, the trade surplus that India runs with the US. Number two, the tariff level, tariff rates, how high they are. Also, we are looking at now GST, because in the press release that the US administration released for reciprocal tariff discussion, they mentioned about VAT in different countries also being higher compared to the US. US does not have any VAT. So when you consider tariff rates, the fact that India has GST, which US does not have, and then the third thing that they are looking at is non-tariff barriers. So when you consider all the three factors, we think India will find it difficult relative to this whole reciprocal tariff issue that the US has raised. The other two countries which are in focus is Vietnam, and to some extent, not two countries, but three countries, to some extent Korea and Taiwan. Taiwanese economy will also be facing some challenge related to this reciprocal tariff stuff.
Okay. Mr. Srivastava, thank you very much for joining us. If you can tell us, category-wise or product-wise or sector-wise, who is vulnerable? Which sectors are vulnerable? You know, you have a stock market audience listening to you, and that's their big worry. Who are the vulnerable sectors? So I think you're on mute. No, we still can't hear you. Okay, I'll just come back to Mr. Srivastava. There seems to be an audio problem. Samiran, you have done the math. What should we consider as, susceptible in terms of sectors?
So there are two different parameters on which you have to judge this. One is for which sectors the tariff differential is highest. And second is that among those sectors, which are the ones which export more to US. So if you do this screening exercise on the sectors, what turns out is that sectors like chemicals, sectors like James and jewelry, some of them, and to some extent now even transport, they are the ones where the impact could be a bit more. But the big challenge for all of us is that we don't know whether these reciprocal tariffs are being considered for across the sector or it's going to be more product-wise. Also, as Chetan mentioned, how much of the VAT type of discussion will come into play, to what extent the non-ad valorem tariffs where India charges less non-ad valorem tariffs compared to US, that will come into play. And last but not the least, how we will incorporate the non-tariff barriers, the quality control orders, etc., into all these negotiations. So at this point, it's very tough to say exactly which are the sectors which will be differentiated and will be impacted more. But the ones that I mentioned in our screening exercise, they come out at the top.
Okay. Ajay, I guess we finally have you. Can you tell us, according to you, which sectors you would worry about?
Lata, before that, I want to tell even Trump administration is not clear how they are going to exercise all these things. Are they going to impose at the country level? Then the impact will be different. Are they going to give one tariff on industry, another for agriculture? Then it will be different. Are they going at the sectoral level? They don't know any of these things because only two sources of information are there, two whiteout notes and one fact sheet issued on 13th February. It is not clear. So, for example, they take the example of Harley Davidson and for the industrial products, and for agriculture products they say entire agriculture sector. So we don't know. Only when they start talking in detail we'll come to know. But I have done an exercise at all the levels. What will the impact? So impact will be different. As I said, if they want to punish India, I mean all the products with the one tariff, then we must know that tariffs are being talked at a very higher level. The real tariffs being faced by the US goods, weighted average tariffs are not that high. So we have done exercise. So at the country level, the average weighted average tariffs faced by the US goods in India is only 7.7%. This includes agriculture and industrial products both. And Indian products, in contrast, face only 2.8% in the US. So tariff gap or differential is 4.9%. We say, okay, so US has a case for imposing 4.9% additional tariffs on Indian exports. That's number one. Now, if they want to talk about agriculture separately, as they talked in, say, fact sheet, then, of course, the US goods, they face 37.7% tariffs in India. Indian goods face 5.3% tariffs. So tariff differential looks like high at 32.3%, but most of the US agriculture imports are at the non-ad valorem tariffs, which means 30 cents per kg or 10%, whichever is higher. These are complicated and real impact will be much more. So India needs to factor this while negotiating the US. Okay. Their tariffs may be actually much higher level.
Okay.
Sure.
Chetan, do you think that we are discussing very prematurely? If clearly your numbers are different from Ajay Srivastava's numbers, and even to some extent Samiran's numbers. If you, I think Mr. Srivastava's numbers don't factor in GST. If we did that, then the differential would be higher. Is that right, Chetan? Is that why there is so much of a difference depending on which source I'm quoting?
No, we have all the various options in the note that we have published today. We have looked at just the weighted average tariff. We have looked at simple average tariff. We have just added an additional analysis related to VAT, which is in India's context, it's GST. But you're right that we don't know, and as Ajay was mentioning, it's unclear what metric they're going to use to discuss this thing with India. But I think the simple message is as simple that India's tariff rates are high relative to other trade partners. And all what the US is sort of effectively raising is that you have to address this. And what India is saying is that, yes, we can do it, but we cannot arbitrarily reduce it for just the US. We have to do a trade agreement. Otherwise, A, it will not be WTO compliant, but also the fact that, Euro area will come and say, hey, you're reducing it for US. Why not you reduce it for us? And so India has to do it under a trade agreement. And that process will be taking time. Just, I think yesterday or day before yesterday, Commerce Minister was saying that it will be probably done by fall of 2025, the trade agreement between US and India. And what we are highlighting in the note that we published today is that President Trump has put a timeline of April 2 for reciprocal tariffs. And the trade agreement will take time, so it will probably be the fall of 2025. And so what happens on April 2? There is a risk that tariffs on India may go up. What is the metric that they're going to use and how much tariff they will impose is still not known. But there is a risk that there will be a rise in tariff on India before the trade agreement can be signed.
Okay. Oh, well, yeah, so April 2nd becomes important. Actually, my other problem with President Trump's announcements is everything is deferred. Other than the 10% on China, the 25% on Canada and Mexico, we will know on first week of March only whether they come into effect. The steel and aluminium 25%, we will know only on March 12th whether they will come into effect or whether that is again a threat and that will be pushed forward for whatever reason. And then we will know, of course, on April 2nd. So the next 40 days become crucial. But Mr. Srivastava, since you've been in the Commerce Ministry and you know how government works, is it practically possible for the US to have so many customs officers that, cashews that come from India, this is the tax. Cashews that come from the Middle East, this is the tax. I mean, this looks like a nightmare for any commerce department or customs department to implement. And then you have the DOGE, I don't know whether you call it doggy or dodgy, but they want you to reduce the number of people. So what is your sense? Do you think it will be product by product? Or do you think it will be, country by country? What will they do, you think? What is the most likely scenario?
So, Lata, I don't think it will be much of a nightmare for the customs officers because now software will tell what duty from what country is applicable, but it will be a bigger nightmare for the people buying from it. They buy based on the best value they obtain. Now they have to forgo about the best value and they have to add tariffs to that. So they may not be getting the best products at the best value. Now they have to factor the tariffs, and tariffs keep on changing based on the negotiations. So there will be no long-term negotiations. It will be detrimental to the global trade. I mean, since he's talking about tariffs on all things, there will be massive restretching of the supply chains.
Okay, now, I have to take my first break, but I want a monosyllabic or a single sentence answer from all of you. For a stock market audience, what kind of sectors should they worry about at all? Samiran?
I would say it's chemicals, transport, and to some extent, gems and jewelry.
Okay. Mr. Srivastava?
Chemicals, pharmaceuticals, jewelry, electronics, and automobiles.
Okay. Chetan?
I'm just mentioning about the top high sectors, the sectors which have high tariff rates for the US, which is basically agricultural products, chemicals, pharmaceuticals.
Okay. So chemicals, pharmaceuticals, clearly we will have to be very careful. In the market, we are kind of randomly worrying about a whole lot of companies. But I think we should take home what Chetan is also pointing out, that, the president is saying April 2nd, but a trade agreement will take some time. So it's quite possible that India will buy time and the stock market need not worry in a granular level right away. It's quite possible that will be the outcome. But all those questions of possibilities and therefore, impact on the macros, all those questions coming to my guests after the break. For Maza viewers, of course, after the break, it'll be Chartbusters, but you will get to hear this entire conversation after market hours.